Well, good morning. If I haven't had an opportunity to meet you yet, my name is Jack Crawford. I'm the general partner here at Impact Venture Capital. Thanks for coming to our office this morning. I think many of you were here for the 1 Million Cup session, which we do every Wednesday. We hope you come back and visit us again. Our firm is investing in early stage technology companies, and there's two elements that sort of differentiate our VC firm. One, we're globally focused, but we pay special attention to tech companies that are inside the technology triangle between San Francisco, San Jose, and Sacramento. And so we're looking at global market opportunities, but we're particularly interested in technologies and entrepreneurs that are born out of that geographic region. The second thing is that we really like working alongside of corporate venture groups. So as you may know, corporate venture groups were they participated in 1 out of every 10 or 12 venture capital funded companies a few years ago. Now they're 1 out of every 4. When you go to industry conferences, maybe a few years ago there were 80 or so corporate venture groups that were pretty active, Intel and Google and others. Now you go back to the same conferences, there's 480 corporate venture groups that are there. So they're a source of capital that's very important to entrepreneurs. Oftentimes they can provide market insight, they can provide early partnerships, they can provide funding, they can provide access to customers. They're playing a critical role in the development of early stage technology companies, and they're becoming more and more important to entrepreneurs. So I'm excited today to have a member of the corporate venture industry here. George Kellerman from Yamaha Motor Ventures, and so I thought we'd sort of start by welcoming you and
Thank you.
And then having you just talk a little bit about your historical experience prior to involvement at Yamaha. I know you
Sure.
did some things at 500 Startups, and you were involved in sort of a couple of other entities. For the benefit of the audience here, why don't you just talk a little bit about your background?
Yeah, absolutely. So my name is George Kellerman. I'm the COO and general partner at Yamaha Motor Ventures. I'm one of the founding members. And as Jack said, we're one of those 400 plus corporate VCs that have launched in the last couple of years. And I'll talk a little bit about that in a minute. As far as my background, I actually am formerly a firefighter in the Air Force, and so I'm blue collar. I am not some Harvard grad. I hope you didn't go to Harvard.
I didn't. Well, we have some really smart people here that did.
But my point being that I really started. I built myself up, and I got stationed in Japan, and I learned Japanese. I actually taught myself Japanese while stationed in Japan for 3 years. Later worked for the Japanese government as a coordinator for international relations. Went to law school at Berkeley, and then I was really kind of coming out of law school right as the internet was taking off in the 95, 98 timeframe. And I worked for a law firm called Venture Law Group, which was on Sand Hill Road, right there. It no longer exists, but at the time we only worked with startups. In fact, some of the early partners that came to Venture Law Group used to represent companies like Oracle and Intel, and we actually fired those clients and said we're only going to work on startups. The internet was just booming, and it was all greenfield at that time. I eventually went in-house at Yahoo, became one of their in-house corporate counsels. And then I moved to Yahoo Japan, and I also, where I ran business development, and then I also ran Dell's consumer business in Japan, selling online and through retail. So I've got kind of a broad experience in a lot of different areas, from firefighting to management, sales, marketing, legal, business development. I actually left Dell in 2010, moved back to the Bay Area, and connected with Dave McClure, the founder of 500 Startups. And I ended up joining 500 Startups. I was there from 2012 to 2014 as one of the managing partners. I basically ran the back office. I was doing all the fundraising, legal, finance, investor relations, that type of stuff. But I was also an active investor at that time. I led about 30 investments, but we were investing in about 250 companies a year, average 25, 30 investments per month. I mean, we gave a new definition to high volume investing. And that really kind of helped me prepare me for what I'm doing now, because a lot of investing is, as you know, Jack, it's learning to kind of see through the what questions to ask, see through the the pitch and really get to what is the core business, what's the value proposition, you know, kind of like what you guys were doing in the 1,000 Cups this morning. What's the real value that you're offering? I was actually recruited to join Yamaha as one of the founding members of Yamaha Motor Ventures, partly because of my broad background, because I speak Japanese, have worked for Japanese corporations before, a new corporate, new investing, new legal, and it was new for us. And this is why I'm going to here is they were really looking for a generalist, a jack of all trades, because they didn't know what they were doing. I mean, as a company, Yamaha as a brand is 130 years old, started as a piano manufacturer and an organ manufacturer, and then 60 years ago Yamaha Motor, which is what I'm part of, spun out of Yamaha. Our first product was motorcycles. So here's a company that went from making pianos to making motorcycles, and now we're thinking about what's the third act for Yamaha. And the reality is Yamaha's kind of a classic not invented here company. We spend $1 billion a year on R&D, but if it's from outside our company, it's just too foreign to us. And we recognized as a company that we just could not keep up with the pace of change. And not only that, but the systems are becoming more and more integrated, and you can't be a specialist in all the different underlying components and parts to it. And the only way we were going to get there was through investing and partnering with startups and leading technology companies. So that was kind of the birth of, sorry, that was a long story.
But that's right in line with some of the trends that we're seeing. I mean, you have corporates that are trying to identify new products. They're trying to position themselves as a technology leader to attract the talent and position themselves as cutting edge, and they recognize they can't just put more into their internal R&D effectively and identify new ideas and new products. So they're crowdsourcing innovation in a way by looking outside their four walls and saying, how can we engage in ecosystems either by geography or by industry in ways that produce relevant ideas, technologies, people to so that their core business. With Yamaha, when you go from pianos to mini bikes to sort of what's next, it just sort of seems like there's been this broad sort of diverse sort of area, these products that are jumping from one industry to another. So as you look at sort of investment focus going forward, are there core areas that you guys are thinking about where you can leverage the historical sort of expertise that Yamaha has developed since its inception going forward?
Yeah, absolutely. In fact, the area that I'm personally focused on is AgTech broadly. More specifically, agricultural automation and robotics. We have ground vehicles. Everything we make can be used in a harsh outdoor environment. We have side-by-sides, ATVs, motorcycles, wave runners, boats. They can operate very well in water, dust, dirt, heat, you name it. And that's the environment of agriculture. But ironically, we really don't do anything in agriculture. We have an unmanned helicopter that's used for agricultural spraying. Actually, 1/3 of all the rice fields in Japan are sprayed using our helicopters, and we just completed our first season of spraying in Napa Valley. But that's a very specific application, so we don't really think of ourselves as an ag company. We don't really have ag DNA.
Is this a true helicopter, or is this like a big drone? I mean, can you describe?
It's a helicopter.
Okay.
It's unmanned, but
Okay.
it's got a 10-foot rotor. It stands about 3+ feet off the ground.
Okay.
It carries upwards of 50 to 60 pounds of spray. It can stay aloft for an hour. Yeah, it's a pretty heavy-duty workhorse. Yeah. Actually, under Japanese export trade control regulations, it's classified as a missile. Because of the IMU in it. So it's the real deal. It's not a little DJI toy. It's it'll do some damage if you know how to use it. But agriculture is a great example where again, we don't have this ag DNA, but there's clearly a huge need and opportunity for automation and robotics in agriculture. And we also have a robotics division, and so we're making robotics, robotic arms and actuators, SCARA and Cartesian robots, but those are all being used in like clean room applications. We have high-speed pick-and-place machines. We're making circuit boards and PCBs, but they're not being used outdoors. So we have all these technologies, and we want to try to marry them and figure out how can we actually provide value to growers. And when you talk about the golden triangle, this area is also just a hotbed of innovation because of its close proximity to 50% of the country's fresh fruit and produce.
Yeah. When you look at sourcing innovations in line with the focus that you have, and I realize there's other people on your team that have different focus areas. You're kind of zeroing in on AgTech as a specialization for your personal efforts. How do you think about sourcing, interesting opportunities to make sure you get access to, industry relevant opportunities for you and your team?
So a couple of the areas we're looking at are urban mobility, last mile kind of transportation, low speed, urban shuttles, autonomous shuttles. So we're looking at autonomous vehicles. We're also looking at medicine, aviation, some areas that are not currently areas of focus, just like agriculture.
Yeah.
And because it's so broad, what we find is through a variety of things. We're a new team, but what we immediately just started doing was attending demo days, signing up for newsletters, coming to events like this where we can meet startups. But more often than not, interestingly, and it goes to what you were saying about there's been this explosion of corporate VCs. Corporates tend to be very conservative, and they like their buddies to be in the deal to kind of de-risk it. And ironically, so we invested in Precision Hawk, which is a drone company. They started in agriculture, but they're also doing other infrastructure. The Series C round was all corporates. It was us, DuPont, Docomo, which is the largest mobile carrier in Japan, Verizon, USA Insurance, and I'm forgetting one other. But it was 100% corporates, the entire round. And so a lot of times it's other investors that we have other corporate VCs that we have good relationship with, because as you said, we're all trying to outsource or develop these technologies, but we also know that we don't have everything that the company may need. And for example, if I know a company needs a telematics or a connectivity solution, the investor I'm going to call is Verizon. We have a really good relationship with them. We've co-invested in 2 deals. I'll pick up the phone and call them and say, hey, you should look at this. And they're going to take that call more likely than sending it to a random VC or a friend because it's relevant to their business. Well, and I've already screened it for them.
That's incredibly validating to something I saw 3 or 4 years ago. I was the moderator of a panel of 4 corporate venture capital firms that had just launched, and there were 150 corporate venture groups in the room, and we were the only VC. And the discussion was we were only the only traditional venture capitalist, right? They were all investors, but they were trying to figure out how they could engage in the ecosystem. And one of the themes that came out of the conference was they were going to syndicate rounds of financing with each other. And so to your point, if you get a pre-screened investment opportunity from someone that you know at another corporate, and you know they can add value beyond capital, then obviously it's going to go to the top of the pile of the 1,000 investment opportunities that you look at each year. And for us, candidly, we're starting to collaborate more with corporate venture groups as well because of the market insight and strategic value beyond capital that they can provide to the companies that we invest in. So, we envision 1,000 entrepreneurs coming up that elevator over the next year, and we don't know which one of them is going to go public on NASDAQ in the next 3 or 4 years, but we want to leverage the expertise of the corporate venture groups to kind of weigh in and give us insight as, hey, if this company builds this product, would you buy it? How much would you pay? How would you use it? Is it relevant to your industry? Can you talk for entrepreneurs who are just trying to figure out how to engage and how to have those early conversations to be relevant and efficient for groups like Yamaha? Can you just talk a little bit about your sort of the beginning process of sort of engaging with an entrepreneur and sort of how do they sort of get to your desk and then get to the top of the pile with regard to the investment opportunities you're looking at in this calendar year, right?
So when I was a traditional VC, if somebody just cold called me, almost guaranteed if I just got a random email through LinkedIn or they found my email on the website and they emailed me, if I could tell what it was, I didn't even open the email. Interesting though, and this is where you can really stand out, is do your homework on the corporate. If you're really targeted and you're like, hey, I've seen that you've done these things in this space or you're interested in this space. I saw you talk at a conference. I have this very relevant, don't talk about your business. Don't talk about what you're fundraising. Don't talk about me. I hate to say it, but that's all because we're not doing this for financial returns. I don't care if you're a billion-dollar business if you're completely irrelevant to our company. And I'm amazed even today how many people will cold call me and send me, hey, you might be interested in investing. And I'm like, what is the connection with Yamaha? So, and part of it is just doing your homework and being really prepared so that you can have that meaningful conversation. I've actually taken some of those emails and followed up, and they've turned into conversations where we're now doing projects. So that's the other thing, as I've mentioned, is don't necessarily just ask for money. In fact, we've done 4 investments, and by investments I mean we've done cash for equity. 4 investments in the past 2 years, but we've done over 20 projects where we've given vehicles, robots, or technology to startups. And the only thing we ask for them in return, we do it under what we call an evaluation agreement, is we say, just tell us how it performed in your application. Because you might be a future customer. Like if you're incorporating our robotics into your solution, well, we'd rather you get one from us for free than you go buy our competitors. Number one, because then if you do succeed, we're going to be first in line, hopefully. But also that feedback and learning we can get, like maybe our product's not perfect for your application. What do we need to modify? We recently participated in the AgBot Challenge, which is an agricultural robotics challenge. We gave away 9 vehicles, 6 side-by-sides, 2 ATVs, and a golf car. To some of them are private teams, some were universities, and they all converted them into autonomous either sprayers or planters. And what was really interesting is just seeing 9 different people take regular off-the-shelf vehicles and make them autonomous. How'd they do it? What were the challenges they had? So that if we really want to be in that space, okay, we need to, for example, if you take like a traditional side-by-side, if you push on the accelerator, there's a cable that goes back to the engine and it pulls the fuel. I don't know what you call it. I'm not an engineer. Lets fuel into the engine. Well, so what everyone had to do is they had to figure out some kind of way to actuate physically push the accelerator. So they'd make some linear actuator and they'd set up some control system. And everyone said, well, it would be really nice if you just had electronic throttle control. From a manufacturing standpoint, it's probably not actually a huge cost. We'd have to design it in. But just knowing that and knowing, okay, that's those kind of simple things, and they might be really obvious, but simple things that we could do to make our vehicles so that people would want to use them as platforms.
My teenage son is waiting for Yamaha to come out with not only a driverless golf cart, but a drone that can fly over and sort of track wherever his ball's going.
So we've had that conversation actually.
Is that right?
Yes, we actually have a drive-by-wire golf car that has an electromagnetic induction system that can follow a wire buried in the ground. We sell it to golf courses. It comes with a little remote. If you hit your ball, you can walk over to it and you can push the button. And now it only stays on the wire. It won't come to you.
Right.
But it'll go down. You don't have to walk back to the golf car and get in.
Right.
And then we had a conversation with Rakuten, who is doing drone deliveries in golf courses in Japan. And we said, well, could you land it on the roof of one of our golf cars?
Deliver a hot dog and a beer? Or?
Yeah, why not? The roof of it's flat. It's flat. You can put a big target on it, put a big QR code or something, and a little sketchy. If it fell or missed, it might take someone's head off. But we had the conversation, so you're not far off.
There's a high demand out in El Dorado Hills for that product. I've seen corporate venture groups sort of segment themselves in a couple of different categories. There's one group of them that are working inside the corporation. They require business unit sponsorship for every investment that they make. There's another group that effectively is working inside the corporation, but they have some autonomy. They'll look and make sure that it's sort of strategically relevant to the overall corporation, but they don't require sort of a partnership with an internal business unit to make the investment. And then there's a third group that effectively is operating completely independent and oftentimes has a different brand, but its sole source of capital is from the corporate. Mm-hmm. Are those the right categories? Is that how you view the breakup of the corporate venture industry? And then I'm assuming you fit sort of in that first first category?
We're closer to the third and second one.
Okay.
When we launched, actually, our mandate was the future of Yamaha. So the things that we thought we should be investing in didn't actually have relevance to our existing business. we thought we went from pianos to motorcycles. Okay, well, and so that's why AgTech is very interesting. We're thinking in terms of new industries, not just new products. How can we move the company into a new, and maybe become Yamaha Motor, and then Yamaha Agriculture? There might be a third company at some point. So we're really thinking broadly in terms of how we can invest. So we started out that way. The reality is we don't have a separate fund. Our money comes off of our corporate balance sheet, which means management in Japan has to sign off on every investment. And I actually was presenting to the management committee one time, and they asked me why we presented the 4 investments that we did in the first 6 months of launching the company. And I said, yeah, it's very simple. It's because we picked things that we thought you could understand. It had to be close enough to our existing business. If it was like just way out there, they'd just be like, what?
Yeah.
And so we picked things that were close, but we didn't have to have any kind of BU sign off to do those investments.
Okay.
There was none. In fact, Precision Hawk's a really good example. They had sensors and analytics and data. Now they had their own fixed wing drone, but that wasn't what was interesting to us, and it wasn't interesting to them even. They built their own drones. They needed some way to demo their software and their sensor capabilities, and we have this unmanned helicopter. And we thought, well, there'd be a great way to maybe marry them and create a new business. And so conceptually, it was close enough to our existing business. Like, okay, yeah, we can kind of see that. We've thought about putting sensors on our helicopters, so it wasn't like totally foreign.
Right.
And then from there, we made the investment with no kind of partnership commitment, and then we had ongoing conversations about, okay, what does that look like? How do we integrate the technology? What are the requirements? Like, do we have to modify our helicopter to actually accommodate their technology? And so then our BU gets kind of involved.
I see. Okay.
So it's kind of it's a hybrid. But I will say that this past year we've been more focused on projects, where our business units are now we kind of I don't want to say this. I hope this isn't going to be tweeted out. We kind of showed them up. We showed them what we could do in just 1 year of just going out there and investing and talking to startups, and they're kind of like, we kind of woke them up. And the CEO mandated, okay, I want all you business units now to be starting thinking about your own future. And the interesting thing, it's really kind of flipped internally. It's become a pull instead of a push model. Mm-hmm. They're asking us, hey, do you know anyone in this space? Or can we collaborate with you guys? And they're like coming out and asking us to bring people to the table and meet with them.
That's interesting. Let me ask you a process question. When we look at investment opportunities, we're looking at from a due diligence perspective. We look at the overall size of the market. We look at the technology and see what kind of sustainable competitive advantage it could bring. We look at the sales sort of traction with customers. We look at the team and finance. Those are the areas that we kind of dive in and do due diligence in a variety of ways prior to making any investment. Can you talk just sort of about the typical sort of process that you go through and maybe the timeline and just give sort of entrepreneurs an understanding of what to expect when you do get interested? You've had that initial introductory meeting, you've reviewed the materials, you're impressed with the team, maybe you've seen a product demonstration, and now you've decided you're going to engage in some way. What are the steps that you go through prior to making an investment?
Yes, so there's 2 paths, and I'll explain each separately. One is where we're participating in someone else's round. The other is where we might lead the round. Very, very different diligence process. All the investments we've made to date, we were participating. In fact, we were in the second closing. The company already had a first closing, and we found out about it, and we're like, oh wow, that looks really interesting. And there was no negotiation. The term sheet was set. It was really, here's the deal. Do you want to come in? In most cases, the amount we invested was driven by our desire to have board observer and information rights. Mm-hmm. If we're doing this for strategic reasons, it makes no sense for us to put money in and just be passive and walk away. We need at least to see how the company is developing and growing. So that's kind of almost really a walkway from us. If we're not getting information rights and at least board observer rights, we're not taking a board seat, but we want to know how things are developing and how the market is going and where the trends are. And that's a pretty simple process. We do a very traditional review in terms of diligence. We all have a legal diligence, a financial diligence, look at the team. Then we make a presentation to the management committee in Japan, and it's just a thumbs up, thumbs down. Because at that point, again, the deal's baked.
Okay. Over what time frame typically?
From first meeting to investment, I'd say we averaged about 2 months on the ones that we made.
Okay.
Which was actually really good. Our management committee was really aggressive and willing to move quickly. I can't give any details, but we do have a deal in the pipeline where we're considering leading the investment, and that's becoming a much more complex process because management's asking, well, why are we investing that amount? Why, because it's not just, well, that's the minimum to get board observer rights. That's, what we think the company needs to achieve certain milestones. And we're considering taking a board seat, not just a board observer seat. And then the management's like, well, how'd you arrive at that valuation? And the one thing, and this goes back to what you were saying before about like 400 new corporate VCs, don't assume they understand corporate venturing or just venture investing, period. The terminology, things like participating preferred and drag along rights, it's just maybe just as foreign to the corporate VC as it is to you as an entrepreneur. And so a lot of what it is it's educating management. And so it's a much lengthier process. And like I said, we've got one in the pipeline that we're looking at, but it's not done. So I can't tell you how long it's going to take.
Yeah. Okay. Let me ask you one last question because I know we're short on time. If you were to anticipate sort of where the next $1 billion of revenue comes from Yamaha in some sort of investment or acquisition that you identified, is there one industry sector where it's just sort of it's sort of revealing itself at a higher level than other sort of market opportunities, or one industry sector where you're just like, wow, this something great is going to happen in this industry sector and you want to be a part of it?
Just leading me on. So I have a personal maybe bias in that answer. I believe it's agricultural automation and robotics personally.
Yeah.
I think a lot of the other stuff, autonomous vehicles, some of the other things, they're very crowded space. I don't think the agricultural automation is crowded yet. I think it will be, but it's going to take a little bit of time because the cycle is different. You can't just write some software, put it out there, and test it every day for the next 365 days. One of the investments we made was in a company called Abundant Robotics. It's an apple harvesting robot. Well, the whole entire apple harvesting season in the United States is 2 months long. So they have 2 months to work on their, actual like real field conditions. It's 2 months. Then they have to pack it up and they go to then Australia and then they do the Southern Hemisphere test. But again, it's only 2 months. So maybe 4 out of 12 months are they actually in field. They can set up demos and do kind of internal stuff, but it's just not the same as actually harvesting from a real tree. So that's a challenge, and that scares away a lot of traditional VCs. I've actually spoke on a lot of panels and said most AgTech is not venture investable because it doesn't meet those traditional kind of exit and milestones that you need to actually make it a financial investment. It may, but it just doesn't meet the timeline. So the one thing that I really strikes out in my head in terms of agriculture, and it's really relevant to California here, is the law that was passed last year around the minimum wage increasing between now and 2022, I believe, where it's going to go up to $15 an hour. But that's not the thing that's going to impact agriculture the most. That's going to have a huge impact, don't get me wrong. In fact, growers today are already offering more than minimum wage because there's a labor shortage. Many are offering $12, $13 an hour, again, just because there's already a shortage. So that's not the big problem. The big problem is the overtime law was also changed. There used to be an exemption for agricultural field workers. You didn't get overtime until after 60 hours in the field. And so if you worked in a factory, 40 hours was overtime. After 40 hours, you got overtime. If you worked in a field, it was after 60. Well, that's between now and 2022, that's going to be phased out, and agricultural workers will get overtime. So imagine $15 an hour for a field worker for the first 40 hours, and the next 20 hours is going to be what, $22.50 or $22.25, whatever that comes out to, per hour. And there's already an agricultural labor shortage. How are you going to? You're not going to go find other workers to do those 20 hours at minimum wage. They're not there. They don't exist. And if we build the wall, they're definitely not going to exist. In fact, a lot of people don't realize there's a net negative immigration to Mexico. More Mexicans return to Mexico every year than come in the country. whether it's legal or illegal, it doesn't matter. They're literally, it's a net negative because their economy is doing well, and there are jobs, factory jobs in Mexico that they can go. Why work here in a field when I could be closer to my family and make good wages in Mexico? That's going to have an explosive impact in the next 3 to 5 years on agriculture here in California. Because most of the stuff in California, it's not the broad acre crops where you just put one big John Deere tractor and it's on the auto steer and it goes back and forth. It's all hand labor. And we're either going to come up with a source of workers, which I don't think is going to happen for a variety of economic and social demographic reasons, or we're going to figure out how to automate it.
Let me get your final thoughts on geography and sort of the innovation economy in Northern California in particular. We have an office in Silicon Valley and then an office in Sacramento, and one of the trends that we've seen is a lot of entrepreneurs and companies actually migrating from Palo Alto to San Francisco. Many of the executives that did well in the tech sector have actually migrated out to the Sacramento region, and so we've been, looking at this technology triangle between San Francisco, San Jose, and Sacramento, and saying, wow, there's a lot of interesting activities. There's university activities, whether it's Berkeley or Stanford or UC Davis. There's just a lot of interesting. There's patents, the number of patents filed inside that tech triangle, the amount of investment activity inside that area. When you think about sort of the geography and what's happening in Northern California, how do you view things? Is this where the next great innovations are going to come from? How do you think about geography as it relates to your investment activity?
Well, it depends on what you're looking at. So we have one of our other partners is focused on urban mobility, and every auto OEM has opened a corporate VC or an innovation lab in Silicon Valley, and so you kind of have to be there. But it's also creating a lot of competition for talent. It's if you're a mechatronics or a computer vision or robotics engineer, you can basically write your own salary if you're skilled and good at what you do. And that's not sustainable over the long term, particularly if you're a startup and you're trying to get an engineer. So I think when you look at things like urban mobility, there are just going to be areas and centers where you just kind of have to be. You either have to be in Pittsburgh at Carnegie Mellon, or you have to be here in Silicon Valley. Those are kind of the two areas. But agriculture, and this is why I'm so bullish on agriculture, is because no one's really kind of figured it out, and there isn't a center, and we have the opportunity to create a center here in the Central Valley and in the Sacramento area. And you can still have good quality of life. You can still be close enough to the things that you want in the Bay Area, but you can have cheaper housing, cheaper transportation costs. So there's a lot of advantages. And if we forecast out 20 years, it's just the Bay Area is limited geography. It's going to push out. It's going to push south into San Jose, and it's going to push out here into the Sacramento Delta. So I don't really have an answer in terms of, I don't think I really have a specific answer. I think it's this area. But if we can create some vertical takeoff and landing autonomous helicopters, it won't matter. You'll just pop out here in 10 minutes and you'll be done.
Thanks a lot for taking the time to share your thoughts with the audience of entrepreneurs and angel investors. And we at Impact Venture Capital look forward to working with you and your team at Yamaha.
Likewise. Yeah,
Thanks.
Thank you.
Thanks.
Appreciate it, Jeff.